Welcome back to Terminology Tuesdays, where you learn one personal finance term on a Tuesday. What is today's term? Amortization schedule. Where you see it. I've typically only ever seen an amortization schedule when it comes to a home mortgage. You can also access them online through loan calculators. What it means. An amortization schedule is just a big list of numbers, and what it's showing you is how much of each payment is going back to the bank or the lender in terms of interest, and how much of each payment is actually going towards paying down your debt. And if you don't understand this at least well enough on like a conceptual level, then it could be a recipe for financial failure. Thankfully, it's pretty easy to understand, so let's get into that. Whenever you need money that you don't have and you take out a loan for it, you have to pay back that loan in two parts. Part of that is an interest, that is the bank getting their money, and part of that is the principal, and that's you paying down the debt that you owe. But banks and lenders are smart. They know we may not pay them back, and they also know that the sooner that they get our money, the sooner they can put that money to work and make more money with it. So they skew these things in their own favor. The first thing that you notice the first thing that I notice whenever I look at an amortization schedule for something like a mortgage is how much of the money is actually going to the bank or the lender versus how much is helping me get out of debt. That ratio is really skewed. And it's because the bank or the lender or whoever, they are the people in control here. We are the ones that need their help, and so they're going to make sure that they get all of their money as soon as possible. It works like this. Over time, as you're paying back the loan, things start to kind of even out, and exactly half of the payment will be towards the bank and half of the payment will be towards your principal that you owe. And then towards the end of the loan, it skews all the way in your favor to where just a little tiny piece is going towards interest and the vast majority of it is going towards the principal that you owe. I made a little animation showing this and it kind of does a bad job, but the goal here is to basically show you that in the beginning, the vast majority of the money is going towards the bank's own pocketbook. Then finally, towards the very, very end, we catch up and our principal gets paid off. So why do you care? Why does this matter? Well, you could be someone who's looking to buy your first house. This kind of thing is good to know. Maybe you've already bought a house, but you just want to understand how the mortgage works a little bit better and what an amortization schedule means for you. Or maybe you just want to see how loans like this are broken down. In any case, I think the most beneficial reason to dig into this is just to realize how much of your money is actually going to the bank and isn't helping you. It's not paying off your debt. For me, whenever I look at our schedule and I can see just those massive, like many hundreds of dollars of chunks of money that are going towards the bank's yacht or their private jet or their penthouse apartment or whatever the next like CEO's bonus is going to give him, it just kind of makes me sick a little bit inside. Like I want our debt to be gone so that we have that money available so that we can put it to work for us. I mean, I want to mimic what the bank is doing. They're getting their money because then they can loan it to somebody else. They can invest it themselves. They can build their business. Like they have all the options that way. And I want all the options. If you've made it this far, let's go a step deeper. So the way that your interest is actually calculated is pretty simple, even though there's some math involved. And I'm going to go over that here quickly with a couple of examples. The first thing you do is get your interest rate and you divide that by 12 months per year. So you normally have your interest rate shown to you in something like 3% or 6% or whatever it is. That's an annual interest rate. So if we divide it by 12, we'll get the monthly interest rate. If you had a 6% rate, for example, and you divided that by 12, you would get 0.005. So that's your monthly interest rate. Then what you do is you multiply that number times the remaining balance on your loan, the whole thing. And that's how much you'd have to pay in interest that month. Then you make that payment for the month and that little calculation resets for the next month. So you do that same 0.005 times the remaining balance and that's how much interest you pay that month. What this is really telling me is the power of making an extra payment. What happens with that extra payment is it goes 100% towards the debt that you owe, towards that principal. And so if we lower that amount, we're multiplying it by that same monthly rate, but now the interest is less. So if we keep taking big bites out of the principal, we'll owe less interest, we get it paid off earlier. It's all good things. Let's do a quick example with a home mortgage. Right now where I live in Arizona, the average home mortgage is almost $350,000. So let's pick that for our number, $350K. The average down payment is 6%. So if we do that math, it works out to a $21,000 down payment on average. That means the money that's left that you would need to borrow is $329,000. That's how much the actual mortgage would be. And if we use one of the handy free calculators online that I've linked in the description, we can see here's our amortization schedule. Like I said, it's a big long list of numbers, but don't get lost in the sea of numbers here. What we're really noticing is, like I said before, that first, like 8 years of payments, it's all skewed in the favor of the bank. So they're saying, look, your payment's the same amount, the whole time if you've got a fixed rate mortgage. Your payment's the same chunk, but more of that is ours than it is for yours. It'd be like if you had a pizza with somebody else and they had 7 slices and you had 1. Like, it's really selfish. They're the people that are loaning us the money. They have all the power and the control and the say in this. So they get to structure things the way they want, and they're making sure they get their money. Finally, down here in 2028, it levels out to where we're kind of even Stevens, and half of the payment is towards interest and the other half of the payment is towards principal. And then by the time we get to the very end of the loan, like the last few years, it's skewed way more in our favor and most of it's going towards principal. The other thing that we can learn from this is really in the beginning stages of a loan, it's really difficult to make that needle move. Like, it's difficult to make progress because you're not paying, like, let's say your mortgage payment is $1,300 a month. You're not paying $1,300 off every month. You're paying off like a few $100s. So then if you're living there for 2 or 3 years, you think, gosh, I've paid tens of thousands of dollars on this mortgage. I must not have a whole lot left. Well, that's not the case because you've just been paying these little bite-sized pieces. You've had 1 slice of the pizza, not the other 7/8. So this could be partially why like student loans feel like they're just taking forever to pay off. It could be why it feels like, hey, we've lived in this house for 3 or 5 years. Why do we not own more of it? Like, it's because loans are structured in this way. And outside of just paying cash for stuff or getting like your grandma to be your lender, we're kind of stuck in this format. This is the way that loans work. This is the way that mortgages work. So it's a difficult reality to stomach, but it explains kind of why we get those feelings that we do when we're paying off debt and why the banks are filthy rich. If you have any more questions about this, leave me a comment below, and I appreciate you being here and watching. If you didn't feel deep hatred in your heart after watching this video, please invest in the like button and consider subscribing. Remember, I've got links in the description for you, so if you want to play with an amortization schedule on your own loan in your own terms, you can. Also, sometimes your lender will just send you like a physical one, so if you want that, look through your paperwork and try and find that thing. And if you want to see the full Terminology Tuesdays playlist, then I'll link it right here so you can see the rest of them. We're starting to get a little bit of a critical mass here. We've got a handful of these videos. I literally have dozens of these planned, so stay tuned for more because I'm going to teach you tons of personal finance terms. Thanks for being here. I'll see you later. Bye.